Hey, welcome back again, community. You're here with Real Money, and we're going to be going over a financial plan for recession, and not just any financial plan for recession, my personal plan for recession. So the first thing I'm going to want you to start with, and I'm not going to say that we are going into recession. I don't know that. I'm not a genius. I don't got a magic 8-ball I can shake and get an answer, but it's very possible, right? The jobs, there's a lot of unemployed people. There's a lot of businesses hurting right now. We've talked about that in the past. So it's very possible that a recession could be around the corner, that we might see these stocks turn around, we might see the economy change. So the first thing that you're going to want to do is you're going to want to cut expenditures on unnecessary things like going out to eat and forms of entertainment. Now, the super great thing right now about that is with COVID-19 and coronavirus and all this terrible stuff going on, you're very likely to not be spending a lot of money right now, which is super helpful if a recession comes, right? You're putting all that money away, you're saving it. That's great. The next thing you're going to want to do is save money in a just-in-case fund, like a highly liquid account, a savings account, or something that's going to pay you high interest. Something that's liquid though, something that you can basically get this money in case something happens, you get sick, your car breaks down. It's basically just an extra small fund, even a month or so of worth of money put in it. This is going to be a small fund, nothing large. You're going to want to set that aside first. Then what you're going to want to do is you're going to want to have 6 months worth of expenses put away for your mortgage, for food, for the electricity bill, for whatever the case may be. You're going to want to start putting money away as much as you can every week. And you should have already started doing this, but this is something I want to let you guys know to prepare for future ones or anything that's coming. But basically, put away enough money to cover your expenses, your monthly costs of 6 months. That's going to give you a huge safety net that no matter what comes your way, you're going to be okay. The next thing you're going to want to do is pay down debts that decrease your monthly cost to live. You're talking credit cards, pay those off as quick as possible. The interest rates, they're not that great anyways. You really want to pay them off. So things like that, your car payments, pay the cars off if possible. Start making extra payments monthly to get rid of those expenses. Really, you want to limit your debt as much as you can. And I mean, it's okay to have debt if it's good debt. And good debt is any kind of debt you take on that makes money for you. And that's fine. As long as you're making money, it's okay to owe money, right? Bad debt is any kind of debt that takes money out of your pocket every single day, that puts you in a worse position than you were, say before you took the debt on. So that's the difference. You really want to get rid of all your bad debt. Nothing wrong with keeping good debt. Real estate is good debt. If it's generating positive cash flow for you every month, that's great. You want to keep that. But you do want to get rid of any bad debts like credit cards, cars, or any kind of personal loans, anything like that really doesn't, it costs you money every month to keep those loans. So you want to get rid of that. The next thing you're really going to want to do is you're going to want to decrease any margin accounts. So I have a margin account on my M1 finance account, and basically I borrow money when the market was going up to make me more money. So when the market goes down though, what that does is it magnifies your losses. So when the stocks start going down, you're losing money on your money and you're losing money on the money you borrowed that you still have to pay the interest on. So you're going to want to decrease your margin as much as you can, and also it protects you against margin calls. So if the stock market starts going down really quickly, you won't have to worry about your stocks being liquidated to pay for that margin account. You basically won't have to worry as much. It goes along with taking the debt and getting rid of it. It's something that when the markets are good, it does create extra money for you. So margin is a very powerful tool. It leverages your accounts. But when the economy is not doing so well, it's not doing so hot like it is right now, it's a good idea to get rid of those margins to protect yourself against bigger shortfalls in the near-term future. Another really good idea that can help you when recessions or market downturns or even just a bear market is to put money aside in an account specifically to buy stocks when they tank. So when those stocks start going down, they start really dipping really hard, what you're going to want to start doing is buying in increments every time it drops. And by doing that, you're able to dollar cost average your share prices down, which means when it turns back around, you'll be able to be positive or in the money a lot quicker. It won't take as long to recover the lost funds. You're able to buy it at a lower price. It averages your price down. It's actually a really, really useful tool when the bear market happens. Now, I was able to do that with one of my favorite stocks, Sunoco, as it was dropping because, as we all know, oil took a beating and a half. And I was able to buy enough shares of Sunoco to bring my average share price down from, I believe I was at 32 or 33 to now I'm in the 28 range. And Sunoco is sitting at 22, 23 right now. So, right there alone, I was able to get myself closer to being profitable again with that stock. It won't take long. We got a nice heavy dividend coming from it. Should offset some of those losses as well. So that's a really useful tool in recessions to protect yourself and to make future earnings a lot better, significantly better. So that's something to really think about doing. Another super helpful and useful thing to do is to invest in alternative investments. Those are things like gold, silver, crypto, things that are not tied to the stock market per se. So don't get me wrong, I know I'm going to get a lot of hate for saying crypto, but the thing is, it's not tied to the stock market, and it's held up pretty well in this last downturn. Even when stocks are going down, it held up. Now, I don't think you should put a lot of your portfolio into things like this. I think this is more an insurance to protect against the drop. Maybe a few percent, maybe whatever you're comfortable with doing. It shouldn't be the majority of your portfolio. The majority of your portfolio should be in good quality stocks that pay dividends or are high growth stocks, depending on your strategy. But they can help when the market turns, and if they go up or tend to stay flat, when the market tanks, you're able to sell these to buy the stocks at a depressed price. It's a very, very useful tool. As the economy continues to go this way, I might go that route myself. I have some crypto, a little bit I've dabbled in. I have some precious metals put away from years ago. I might end up selling those to buy more stocks. And we'll see as this plays out. But it's a very, very useful tool to also push your returns in the future and protect against losses now in your total portfolio. So if you guys have anything else that you want to add to this, definitely don't forget to comment below. I'm very interested to hear what you guys always have to say. I'm glad we have such a great community, and I'll talk to you guys next time. And don't forget to like, don't forget to subscribe, and I'll talk to you later.